Basic books of accounts. All financial transactions are recorded through the following basic books of accounts: cash book, bank book, journal, purchase register and purchase subsidiary book, and sales register and sales subsidiary book. Transactions. All the above transactions are posted in a ledger in various accounts. Generally, entries related to cash or bank, payment or receipts are recorded in the cash book. All non-cash transactions are recorded in the journal book. For practical convenience, the journal is divided into several subsidiary books. The following subsidiary books may constitute the journal for an enterprise: purchase book, purchase return book, sales book, sales return book, and journal proper. Journal book format. Journal book is used to record all day-to-day entries. Format of journal is as follows. Date is the date of transaction. Account name indicates those two accounts which are affected due to this transaction. Debit, amount for debit account. Credit, amount for credit account. After recording all transaction for a particular period, debit and credit columns are totaled. These totals should be equal. Posting of transactions. After the transaction is recorded, it will be posted in the general ledger. The general ledger contains all the accounts of an enterprise. General ledger serves the purpose of reclassifying and summarizing all the information recorded in the cash book and journal according to account heads, called ledger accounts. Financial transactions. Recording financial transactions. The double entry system of recording financial transactions is a standardized method in which each transaction has a dual aspect, credit and debit. Types of accounts. There are three types of accounts maintained for transactions. Real account, which represents assets, for example, building, furniture, cash, etc. Personal account, which represents persons or organizations, for example, supplier, customer, corporate bodies, and institutions. Nominal account, which records incomes or expenses, for example, sales, salary expenses, purchase, discount given, discount received, etc. Golden rules of accounting. Rules of accounting. For real accounts, debit what comes in and credit what goes out. For example, if we purchased any asset, that asset account will get debited. Or if we sold any old asset, that asset account will be credited. For personal accounts, debit the receiver and credit the giver. For example, if we paid the newspaper agency, the newspaper agency's account will get debited as it is receiving the amount. If we sold our scrap to a scrap collector and he pays us for it, then the scrap collector's account will get credited as he is the giver. For nominal accounts, debit the expenses and losses and credit the incomes and profit. For example, if we purchased some goods, as it is our expense, purchase account will get debited. Similarly, if we sold some goods, as it is our income, sales account will get credited. Example 1. In the books of Star Enterprises, on 3rd June 2017, bought furniture on cash for Rs 5,000. Date 3rd June 2017. Account name Furniture account. Debit 5,000. To cash account, credit 5,000. Here two accounts are affected. First is furniture account and second is cash account. Furniture is an asset, that is, furniture account is a real account. Cash is also an asset, that is, cash account is also a real account. Now let us apply the rule related to real accounts. For real accounts, debit what comes in and credit what goes out. Furniture is bought, that is, furniture is coming in the business. Therefore, furniture account will be debited. We are paying cash against furniture, that is, cash is going out from the business. Therefore, cash account will be credited. So the journal entry of the above transaction will appear as displayed. Example: Mr. A purchased a car for Rs 50,000 by paying cash. Car is a real account and cash is also a real account. The entry in the books of A will be car account, debit 50,000. Debit what comes in. To cash account, credit 50,000. Credit what goes out. Example 2. On 6th June 2017, goods purchased of Rs 3,500 and paid by cash. Here, two accounts are affected. First is purchase account and second is cash account. Always remember, there is nothing like goods account. Whenever goods are purchased, it is denoted by purchase account, and when goods are sold, it is denoted by sales account. If any defective or extra goods are returned to supplier, it is denoted by purchase return account. Similarly, if a customer returns any faulty or extra goods, it is denoted by sales return account. When we purchase goods, it means we are doing some expenses. Therefore, purchase account is a nominal type of account. Cash is an asset, so cash account is also a real account. Now let us apply the rule for nominal accounts first. For nominal accounts, debit the expenses and losses and credit the incomes and profit. Here, purchase account records are expenses. Therefore, purchase account will be debited. For real accounts, debit what comes in and credit what goes out. We are paying cash against goods purchased. That is, cash is going out from the business. Therefore, cash account will be credited. So the journal entry of the above transaction will appear as displayed. For example, Mr. B paid salary Rs 30,000 to Mr. A by cash on 5th April 2017. Salary is a nominal account and cash is a real account. The entry in the books of Mr. B will be salary service account, debit 30,000, debit what comes in. To cash account, 30,000, credit what goes out. Example 3. On 10th June 2017, Sunrise Enterprises paid Rs 10,000 by check. Here, two accounts are affected. First is Sunrise Enterprises account and second is bank account. Bank account is an asset, that is, a real account. We are getting money, that is, asset is coming in the business. For real accounts, Debit what comes in. Sunrise Enterprises account is a personal account. As Sunrise Enterprises is paying us, he is a giver. For personal accounts, credit the giver. For example, Mr. A received an amount of rupees 20,000 from Mr. B by bank on 15th April 2017. Bank is a real account and Mr. B is personal account. The entry in the books of Mr. A will be bank account, debit 20,000, debit what comes in. To Mr. B account, 20,000, credit the giver. Rules. In short, the above rules are narrated as follows. Assets will always have debit balance. Expenses will have debit balance. Liabilities have credit balance. Capital has credit balance. Incomes have credit balance. In short, the above rules are narrated as under particulars and nature of balance. Ledger posting. Posting these entries in respective ledgers. Let us post the previous journal entries in the respective ledger accounts. We have furniture account debit to cash account credit. Amount is 5,000. Purchase account debit to cash account credit. Amount is 3,500. Bank account debit to Sunrise Enterprises account credit. Amount is 10,000. First, post furniture account entry. Here, furniture account is debited with amount 5,000. Therefore, in the ledger of furniture account, we will write to cash account in particular column for the same date 3rd June 2017 with the same amount rupees 5,000. Similarly, if there are more entries for some other dates for furniture account, we will post them in the ledger with date and amount to the debit or credit side as per the journal entry. Similarly, let us post for the remaining ledgers. For the second entry, purchase account is debited with 5,000. So, in the ledger of purchase account, we write to cash account in the particular column for the date 6th June 2017. Now, cash account has two entries on 3rd June and 6th June respectively, both with credit balances. Remember, always total both the sides of ledgers. This is used for the trial balance. For the third entry, bank account is debited and Sunrise Enterprises account is credited with 10,000 rupees. So, in the ledger of bank account, we write to Sunrise Enterprises account in the particular column on the left side. In the ledger of Sunrise Enterprise account, we write by bank account in the particular column on the right side. Assignment. Explain which rules of debit and credit you can apply for the following transactions. A. Purchase of plant and machinery through cash or bank of rupees 1 lakh. B. Payment received from sundry debtors by cash or bank rupees 10,000. C. Goods sold to XYZ company on credit for rupees 20,000 and for cash rupees 10,000. D. Stationery purchased for rupees 10,000 by cash. E. Professional fees received by cash from Patel and Company rupees 5,000. Example 4. Purchase of plant and machinery through cash or bank of rupees 1 lakh. Two accounts which are affected are plant and machinery account and bank or cash account. Plant and machinery is our property, that is, it's a real account. Similarly, cash or bank is also a real account. As per real account rule, credit what goes out, debit what comes in. Example of how to solve the above transactions. Transaction, debit or credit. Rule, increase or decrease. Purchase of machinery. Debit, real account. Increase. Payment through cash. Credit, real account. Decrease. Examples of assets. Assets, fixed assets, land and building, plant and machinery. Cash in hand and bank balances. Stock, stock in hand. Loans given, parties, employees, etc. Advances, advances given to parties for expenses, to employees, etc. Deposits, deposits with government authorities, telephone, MSAB, etc. Sundry debtors, amount receivable against sale of goods. Prepaid expenses, insurance, subscription paid to future period, etc. Examples of liabilities. Liabilities, capital account, proprietor or partner, equity share capital and preference capital, secured and unsecured loans, loan taken from banks and other parties. Sundry creditors, purchases on credit, duties and taxes, liabilities for expenses. Assignment. Example, rupees 500 received from debtors. Amount paid to creditors rupees 1000. Purchase of asset through cash or bank rupees 2000. Assets sold and amount paid to sundry creditors rupees 3000. Classify these transactions as per the above table.